Morning, good afternoon, good evening. Welcome everyone for lesson 22. We're to speak about a very important and also very fun topic about DeFi. We are almost at the end of a bootcamp about blockchain, about tokens, EVM, smart contracts and all, right? But how many times did we use like cryptocurrencies or anything related to like payments or investments in this bootcamp? Have you noticed that most of the things that we're speaking about are about programming, about building things, not speaking about investment at all? Which is funny because most of the things that we see out there in the media, when we speak with common people, parents, and the masses, and all, when we speak about blockchain, people instantly think of what? Investments, crypto, pump and dump, profits, maybe moved by greed or by usage or whatever means that they automatically assume that most of the things, if not all of the things related to blockchain, are for crypto. Number go up and number go down. And if you chat in Telegram groups, in Twitter pages, in X pages, whatever, about blockchain, most of the talks is crypto. What to invest into, how to make your money grow, how not to lose money, how to trade, and all of that, right? But in this bootcamp, we have just one lesson about this, one small lesson. Of course, we understood tokens, we understood all of that before, because for me and the whole scheme of deploying, developing things on the blockchain, DeFi is just one of the many things that you can do. I know it's what gets most of the attention out there, getting rich with crypto, but for 90% of more the people is like losing money with crypto and sometimes getting scammed with crypto or bad things. So this is why today I'm going to give this lesson, this DeFi lesson, with an engineering point of view. How DeFi works as a system, how smart contracts can enable the industry of decentralized finance, and I'm going to teach you how to build things or how to implement things with DeFi, as we saw in other lessons. Okay, it's not about operating or trading. I have just one trade technique which I can share with you all the time, and it works with 100% accuracy. Okay, let me tell what technique it is. I watch the market with a lot of attention, and I wait until the prices are in the top, like before Trump announces any tariffs or anything crazy happened, China banned Bitcoin. So before anything like this, I buy like at the top. When the price is increasing, I wait, and when it is in the top, I buy. And then when it starts to fall, I don't touch my investment. I'm not even paying attention to it. I keep watching it fall. It goes up and down. I don't care. I don't care. And when it's falling, when everyone's sold, there is no one else watching that market. And then at the dip, I sell there. Okay. And then I lose all my investment. This is the only trade strategy that I know. I've been doing that for years now with 100% success rate. I lose every time. Okay, so this is the only trade technique that I know. Just kidding, okay? This is just like I tried investing in the past, bought Bitcoin at a good price, sold, had some profit, and then lost everything. And the common talk for investors, right? I evaluate technically very well, but I don't know how to evaluate markets and trends and all. So I lose money every time I invest. This is why, I guess I've proven my point. This is why I'm not going to speak about investment, about getting rich with cryptocurrencies or anything like that. Okay. I can teach you how to build these systems. I've worked building wallets. I also built a real world asset platform for a client. I've built some payment integrations in Brazil, Latam, one in Europe. I've doing these kind of integrations for a while, so I know the technical part, but I know nothing about trading. So today is not a lesson about trading. It's not a lesson about operating DeFi, where you land or where you stake or anything like that. It's a lesson for how you build smart contracts that would operate financial services. Okay. Yeah, let's me that's very clever. Every time that you want to profit, you just do the inverse operation that I do, and then you make a lot of money. I use it to do that with my friends. Okay, but if you chat with people that technical people that try to invest, you're going to see this story repeating very often because technical evaluation is just one factor of investment. You can see an investment and see, oh, that's a bubble, that's a Ponzi. I'm not going to put money in that. And then it goes up crazy. Because bubbles are profitable, right? They are bad, they are dangerous. And we're going to see that today too. But when a technical person say, this is not sustainable, I'm not going to invest, probably that would be the most um, sane thing to do, but the markets are not sane, right? So let's close this discussion, this whole topic subject about investment, and let's understand how to build financial services using smart contracts, using blockchain. Okay, and we're going to go way beyond just payments. Bitcoin introduced a peer-to-peer electronic cash system, okay, for you to hold assets and pay people, but we're going to go way beyond that. And to begin with, we need to understand the financial services sector as an industry, as a system, a working system, just like we understand, for example, voting or governance or lotteries or anything like that. It's a service, okay? There are people that want to deposit some value that is scarce, something that they have and other people don't have, economy because it's scarce. Okay, we cannot deposit air, breathable air, because it's abundant. We cannot deposit sunlight because it's abundant, but we can deposit gold that is scarce. Okay, you see there is one person with this money preference, and there is another person needing that asset, or they need to spend because they got ill, or they need something, they want to buy a house or something. You connect those people with an industry, with rails, with infrastructure, with providers, and then they transact. Here you can understand financial sector just like you understand roads and cars and airplanes and all. There's an infrastructure that makes that service work, okay? The confusion comes because most of those services that we're going to speak and see today, they are heavily regulated and operated by central banks or operated by countries or legal tenders in countries by using law, you know. So there is a lot of politics, democracy, blah, blah, blah involved behind because they're heavily regulated sector in globally. This is not like that with, let's say, phones or any other industry that we see. But this doesn't mean that the financial sector is still not an industry. We can understand the machinery of financial sectors, and the governments, the politicians, and all are just the players here. When we study, for example, banks, investment houses, insurance, real estate brokers, lenders, all of these players, they are a little cog, a little component in this industry, right? And thus they can be automated. They can be um, operated through smart contract to decentralized financial services. Okay, that's my point here, because there is often a discussion about capitalism versus socialism versus state control of the currency versus liberalism, anarchism, and blah blah blah. And this discussion is valid in the social part on how societies coordinate themselves. I do have my political opinion, but regardless, I don't want to pollute or poison this lesson with my opinion. In the engineering point of view, regardless of capitalism, socialism, whatever, this is an industry. It works, it has providers, it has players, it has incentives, and the regulation and everything coming from the statewide using violence or using force is just a play, it's just a vector that we can organize here. Okay. Whenever we are speaking about decentralized financial services, we're speaking about having banks with smart contracts, having investment houses with smart contracts, having finance companies with smart contracts, lenders, real estate brokers, insurance companies, and all of that with smart contracts. But there is one thing that a smart contract cannot do that the regulator, a central bank, or government, whatever, can do. And this is the division from water to wine on how we would design those decentralized financial services. Okay, and just to bring a picture that this is real, that this happens. And now I have this chart here on DeFi Llama, where we're going to see some examples of this, of the size of this market. We're speaking about $88 billion in this market in many different players that do lending, liquid staking, restaking, trading, currency exchange, a lot more. So yes, it is possible to bring all of that on chain, but I'm going to explain the difference. You know that one thing that smart contracts cannot do, that central banks they can. Central banks can print money out of thin air and enforce that money, make you use that money, make you pay that money, make you collect that money by using structures, institutions. Some people call that violence. Some people call that force. Some people call that institutional power. They can enforce this money and they can control, they can operate the issuance of the money, M1, M2, M3, and all of that, and make that money flow and make the financial services work from that direction. We are seeing that unfold on before our eyes this week and last week with the whole thing happening in the United States. But we saw last year and the year before with the banks crashing. Now it's very easy to see that a system unfolding. But a smart contract, whenever we are building DeFi, decentralized finance, those smart contracts, they cannot arrest you if you don't pay taxes in this token currency. They cannot force anything. They cannot pass a law for anything. So the only thing that smart contracts can do, the same thing that blockchains can do to attract people, keep people mining and all, the only thing that decentralized finance can do is to give you incentives for attracting people to do peer-to-peer financial interactions. Decentralized finance needs to attract people with incentives. Usually, what kind of incentive we give? Yield. You put your money here, you're going to accrue yield, you're going to gain more money over time, and this would compensate for the risks. This would give you some profits. And this is the base of the incentives for decentralized finance. Yes, there are debt issuance, governments, central banks, they also issue debt and offer paying, but let's keep that talk. You know that the system is very rigged, and it's not my opinion, it's a fact. We can see it out there, and there's no one disagree with that. Even like right-wing, left-wing discussion, everyone's agree on the current state of things, right? For decentralized finance, you don't have that legal tender way for enforcing that to go through. So you need to give yield, you need to give profits for people. And here are another very important grounded discussion. Very well put, Ryan. Like the human condition, how we put this natural feeling, this natural effect of being attracted by yield and profit. Should we call it capitalism, greed, or anything like that? Or is this a natural law, expression of a voluntary interchange of value? Let's do one exercise. I'm not going to quote finance books or economy books or anything like that. Let's just go from our natural feelings, and that is enough, dismissing any other kind of construction of financial construction that we build on our heads, right? I'm going to give you one example. I'm going to borrow $5 from you. I'm going to play the lottery. If I win, I repay you the $5. So we are good. We're quits, or call it quits. If I lose, I don't pay anything. You lose and I lose too. So if I win the lottery, I repay you back. We're quits, fair and square. If I lose, I don't pay you anything, and I don't win anything as well. It seems like a fair exchange, right? We're just missing one little detail that is a natural expression. Do you feel that this arrangement is fair for both parts? Naturally, even without studying economics or administration or anything like that, do you feel that this arrangement is fair? Be honest with yourself. What are the odds that I win the lottery? It is fair for me to keep all the prize if I win, or it's fair for me to not repay you if I lose? What do you think? Okay, no way, it's not fair, right? Dante, what do you think? Would you feel that this arrangement is fair? And explain why, because the why is the important thing here.
Well, because I think the why it's not fair because you had to pay for information. Like you have to pay in order to have that chance. Um, that's what makes the prize. It's what makes the whole. Like your part makes the whole that is able to win. If not, it wouldn't work.
Yeah, and I could argue, oh, I'm super lucky. So you are investing in a lucky person, something like that, right? But you all see that this doesn't make sense, right? And the word that we are missing here is the word risk. There is a huge risk that by putting these $5, you're going to receive nothing. So you want to be compensated for that risk, right? You want to have profit. So if you give $5, you want to receive way more than $5 to compensate for that risk that you put, right? So this, people, is not an invention of capitalism, of monetary finance, or anything like that. This is a natural expression of voluntary exchanges. And since decentralized finance cannot force anything on people, you need to attract people with incentives for it to be peer-to-peer. So it's voluntary. It cannot use force or violence or anything like that. It needs to provide more incentives, more attracting factors with profit than it gives of risks. Otherwise, no one would engage. Is that clear for everyone? Okay. So this is the revolution of DeFi and society without central parties and blah, blah, blah. Yeah, but in the talk is very beautiful, right? But what we see in practice, now the second part of this discussion, is that you have a lot of value here flowing for serious people and going and all, right? But what you see, it's a lot of discussion about this kind of attractions that all of this money that we have in this decentralized financial system, all of this money locked came from people, normal persons, normal household or institutions or corporations, and allow they put this money there in the form of tokens. They enter in fiat, they deposit there, and okay, eventually that becomes crypto, and then we have all of this money there. Whenever we are giving them yield, there is this discussion of giving real yield, money that is actually generating value and growing the economy, with air quotes because it's tricky to measure now when we speak about smart contracts, and money that is just inflation, like the printer going and printing money. And there are different opinions. There is the opinion of Binance that is saying that not all yield, for example, there are yields that are not sustainable or real. And they say that is not necessarily better than dilutionary emissions. And this is an opinion from Binance. And we need to understand, well, Binance is going to profit from the transaction fees, whether the tokens go up and down. They just want people to trade, right? So maybe the opinion is biased. Maybe you agree with them. Maybe you have facts on this and all. But that is this whole positioning that some people have that, oh, it's okay to do Ponzi schemes. It's an opinion. If it's a crime or not, blah, blah, blah. Let's all the people to decide on that. Today, like I said, engineering point of view of things. So as an engineer point of view, when we are designing and we are interacting with those financial services, we need to understand this. Where is the money coming from for us to pay these yields for incentivizing those peer-to-peer financial networks? Because there is a lot of mixing of real yield that is coming from actual sources of providing services and now with inflation dilutionary emissions, and the whole thing get very confused in a big Ponzi economics that is called Web3 and crypto markets. You have like 1, 2, 3, 4, 5% of people doing the real thing, and 95 of people just screaming around pumping tokens in pump and dump schemes. Okay? I did not research on these numbers, it's just giving some examples. Today we're going to go through this for 10, 15 minutes, and we're going to see that very in practice with real examples. And then I'm going to show you how to implement real stuff that it's not that necessarily generate revenue, but that works, it stands in, that compiles. This is what I'm trying to say. And if you want to do inflation, you will know how to do inflation too, but you know that this is Ponzi economics. You are building a Ponzi, a pyramid scheme and all, and in some places this is crime, you're going to harm up other people. And if you go that path, well, I wouldn't endorse that path myself, not judging you, but my point here is that as an engineer point of view, if you want to do real value, you would need to go to the right path here of doing real yield. And we're going to see that in this Twitter thread, okay? Different from the position that Binance has here, kind of difference. Well, they put both points, but in this article, we get a more stronger position on that. So this statement here, this is getting a little old, but it's true like today, that many projects are built on unsustainable Ponzi economics backed by inflationary tokens, which means that they are not sustainable. Eventually, they are going to fall down to zero. And everyone that invested in this, everyone that put their life savings, you work for 2 months and then you pick that money and then you put there, you stake your life, you lost 2 months of your life. This is going down to zero because of this engineering system. Let's understand why. There are some real revenue that you can make in DeFi. The revenue that these players do in traditional finance too. For example, trading fees, that they do liquidity provision, transaction fees for services, option on premiums or insurance premiums, borrower interest, lender interest. There are many examples of this kind of transaction that are valid problem-solving transactions in the real world. Okay. So, for example, trading fees. Whenever you have the ability, the liquidity to trade between a pair of assets, you can provide liquidity to this trading pair with a protocol that we're going to see later called Uniswap. We're going to see some other similar to those. And there are 2 ways to give these kind of incentives with trading fees that are real incentives and incentivized real rewards, dilutionary rewards, which are unsustainable. And if a lot of your revenue comes, your yield comes from this incentivized portion, you have something that is not sustainable, okay? So, for example, you have those projects paying for 420% per year or 10,000 per year. Now you think that this is sustainable. Let's understand that, okay, with some examples. Uniswap. We're going to do a test in Uniswap today to see how it works. You have a Uni token, but in 2022, at the launch of the Uni token, the Uni token was used only for governance. You wouldn't have anything of revenue going to the token holders at all. You would have everything going for liquidity providers to incentivize them to provide liquidity for those pools, okay? So the revenue itself is being accrued to the operation of the protocol and nothing in the stake, in the shares, in the LPs, on the token holders. The LPs would receive these fees, but the token holders no. So the token would not accrue value. It's a value design. Different from, for example, BNB, where the token accrue values when the exchange burns the tokens, blah, blah. There are different designs for you to do this. This is financial engineering. You are building your token economics in some directions or no. This is maximizing the attraction for liquidity providers. Being a peer-to-peer network, this is a great leverage to attract more LPs than other protocols. And this is why Uniswap is one of the major platforms for doing swaps, because of the amount of money being provided as with liquidity provision there. Okay. You have a question here, Dante, before we proceed?
No, just a comment. It's just like they put the money back into the business and waited for a longer term reward.
Yeah. See, Uniswap, this unit token here, is not maximized, at least in this design, for pump and dump, because it's not pumpy. It's not being promised of big returns and all. So sometimes the problem itself is worse than the actual economical design. So whenever you come here and ask this question, where the money is coming from, then you break the promise. Like, cut the marketing talk. Show me the token economics. And this is something that less than 1% of those investors do. They just ape in and do shallow researches, and this is a big picture of what's happening in the crypto ecosystem. Another example, protocol fees. There are fee paid for a protocol in exchange for providing a service. For example, bridging fees or fund management fees, marketplace fees, okay? This is a very visual example. What is the probability of an NFT buyer, an art collector or something like that, or a club membership looker or something like that, finds an NFT seller just by walking down the street or going to an event or chatting social media? It's very difficult to find those people and do business with safety, with security, and do that well. This is a pain of the market. If you want to buy an NFT or if you want to sell an NFT, it's difficult to connect securely one with the other. So if you make an NFT marketplace that connects those both people, you are solving a real pain, an entropy of information problem, and you are solving that, giving some rails for them to transact securely with assurance and all. Okay, you are solving a pain. You can charge a fee. You can charge 2%, 5%, 1% of this transaction, and that's real yield. You are solving a pain. You are making humanity a little better, giving value so you can extract value. Another one, very similar, borrowers and lenders. There's a person that needs to borrow to invest, to survive, to whatever. I want to buy a house. I don't want to pay rent anymore. I want to buy a house and pay that over 10 years. So I want to borrow. Now I need to find someone with $500,000 sitting in the bank that wants to lend it for me for an interest rate, just as we discussed it before. It's difficult to find those people walking down the street and to do business efficiently and with security. So if you make a protocol that can connect those two people, you can charge a fee, a platform fee or something, because you're solving a pain. You see, it's not difficult to find a real value aggregation in Web3. You can design this kind of systems that would provide solution for real pains. Why most people don't do that? Why most people do the Ponzi economics part, you know? Well, incentives, right? Doing real business is grindy, take a while, you don't get rich, you need to work, you need to put effort. Oh, you, no, effort, no, I don't want to grind, I just want to get rich overnight. So they launch a Ponzi scheme, whatever. But let's cut this discussion again. So these are examples of real revenue that you can accrue by solving real pains, right? So what are those unsustainable yields, those traps? It's every time that you don't generate real yield and still you want to attract people in this peer-to-peer financial network by offering a yield that you don't have, an unsustainable revenue. You want to give an unsustainable dilutionary emission, trying to attract people, and sometimes they buy a token thinking that it's going to go for moon and it go for zero. Brilliant, right? Well, most of of the financial sector DeFi is like that, and even traditional financial sector. Okay, let's do the spiral. Let's start with this question: which is bigger, a pizza with 6 slices or a pizza with 10 slices? Okay, if I cut this pie in 6 or 10 or 16 pieces, which pizza is bigger? 16, of course, because we have more pizza, right? If we cut it 20, we're going to have even more pizza. So if we keep cutting, like if I cut this pizza in 6 billion slices, I can feed the whole humanity and solve world hunger, right? Because I'm going to have a slice for everyone, the more I cut, right? This brilliant logic is the logic of printing tokens, dilutionary emissions. You pick your monetary base and you cut it in more units and you give for people. Sometimes you can even create some pump because distribution effects, because of marketing, because of something like that. But it's not sustainable. You are picking money from the future and using now. And if you use this money now with more efficiency than the money that you are taking in the future, okay, it's debit. But most of the people do that just to pump, get rich, sell that thing, exit that thing, dump on other people. And now you want examples of that? Open pump.fun. Most of the tokens there, or any meme coin or anything like that. It's just like this. You print a lot of tokens, you use that to gather attention of people, and people buy. The problem is that whenever you cut more of the same thing, it's the same thing just divided in more slices. So unfortunately, and I say this with true sadness, unfortunately, you cannot print money to solve economy. I would love if that would be possible. We wouldn't have problems anymore. Everyone would have everything you wish and you have. You just need to print money. But unfortunately, this is sad, but unfortunately, reality doesn't work like that. In reality, when we print money, we cause problems, we cause inflation. So there are many examples like that of farming rewards and things like this. So you mix the real yield that your protocol is generating, which can be small, maybe it's not going to attract people, it's not enough to pay for the risks. And then you add a lot of inflation to attract people to buy that asset. Can be DeFi, but you can understand that in traditional finance too, like treasury bonds, whatever. You print money just to repay those. And this is going to cause a pump and dump. They mention, for example, the Anchor token. Uh, the Anchor in 2021, 2022 used to subsidize borrowing through inflationary rewards. You would mint tokens when borrowing. So you would pay 20% of you what you are borrowing as interest, but you would receive 20%, up to 20% of that value as incentivized rewards in Anchor token. So it would be great for borrowers. I'm paid to borrow, right? But not that great at all for the Anchor token holders. So when those rewards would dry, the borrowing demand would plummet, the revenue would plummet, the token would go for zero. It happens a lot in decentralized finance, okay? But let's do a parallel. Do you know any country that did that in the last decade? They would put the interest rate almost to zero. You would be crazy not to borrow. And then when they increase it, the interest rate again, everything crashed. You know any country that did that? Yeah, the most famous example is United States of America. They had almost zero interest rate for a while. When they spiked it up, the world is crashing, and now you're crashing even more. Maybe reorganizing, maybe not. I don't know what's going to be in the future. So this happens in DeFi, but also happens in the traditional finance. Okay, it's economy anyway. This is the laws of nature, like gravity. So we cannot escape from that. We can only design systems around that. Okay, so it happens in the traditional sector. It also happens in decentralized finance. Whenever you do that, you have those Ponzi economics, you have those red flags, you have those sustainability problems, revenue that is completely reliant on new token buyers, pyramid schemes and all. Even cool protocols like if you remember Axie Infinity, where you would buy some digital animals and put them to play and all, and then they demand pike it. Everyone wanted to play, to breed and sell more things, yes. But eventually you have so many that the value drops to zero. When the demand is smaller than the offer, price drops, then it goes back to zero. It happens with animals, like anyone wants sheeps. Okay, let's start breeding sheep. Sheep, 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 sheep. Now everyone has sheeps. Sheeps are worthless. So the same thing that happens in traditional like commodity stock markets now would happen in those markets in Web3 too. Okay. Dante, you want to add something here?
Yeah, they go through their cycle, you know, because they're not, what you're leading to is well engineered underneath. They're short term and they're not built well because they naturally uh go into this cycle where they explode and that's it.
Yeah, very well put, Dante. You got the idea of this introduction to DeFi, right? Some projects are designed to be like that, like to raise a lot of capital, create a lot of buzz, 2, 3 years, go there, launch a token, airdrop, blah, 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 and exit. And then they do that again and again and again and again. Some people would consider these people criminal. Some people would agree with these people. Some people would disagree with these people. This is not a discussion for today. This is just an introduction about the DeFi, how we can build those services from the traditional financial services with decentralized finance and those different opinions. You should do things that are unsustainable. You should not do things that are unsustainable. This is DeFi, the ecosystem as it is. Okay. We all introduce it. Let's talk economics. Okay. Now let's get our hands on it. Let's invest. No, not at all. It's not the lesson about investment. Let's do one example of a swap. Okay, using this protocol, Uniswap. I guess I have a link for that. Token economics swap example, yes, but where's the link for this? It is here somewhere, I know. Yeah, here. Wait, I've put in the wrong place. Okay, so scroll up, you're going to see that that link for the Uniswap docs. Okay, you're going to find Uniswap here into the DeFi Llama. as a position 10, that is a total of $3.4 billion in value locked in that protocol for people to do swaps, which explain how is that possible. I guess I mentioned some others here. MakerDAO for doing stable coins. That's a good example to have for doing lending and borrowing. Okay, you have let's quickly go through those two first before going for Uniswap. You have heard of stable coins before, right? Those money assets that are pegged to fiat or real world assets. Okay, Browns, you raise your hand.
Question concerning inflation yield. I wanted to know, because we're talking about, for example, a company or an organization, a DeFi organization tends to actually have like a capital, then they begin to share it among themselves. Then they begin to distribute it among the customers that want to use it, or the vendors that want to use those coins. So I wanted to know, is that the concept behind inflation yielding? So the disadvantage of that will be that there will be increase in tokens or in coins. Then they'll, how, like, I don't know how to put it, but okay, that's just my understanding towards inflation.
Yeah, there is a very easy way to understand this. Every time you are taking an action to deflate currency that someone is holding, it would be the same thing as stealing a little amount of money from them, like charging a tax from them, you know? You would dilute a little more. You have a cup of lemonade, and someone is pouring a little of water on it. Now you have less lemonade and a little more water. You do that with a small value, it's almost unperceivable. But when you do that over the years, like 12% per year, eventually in 5 years, you have nothing. You have just water, and it's worthless, you see? So this is the effect of inflation. Okay, you don't feel it as a hit, but the problem is that it hits everyone. And only who is investing, staking, would receive that yield. Everyone else that is not investing, usually the people that mostly need the money to transact and all, they are being hit the most. Okay, and it happens with your currency as well, like the normal currency, like these little papers that we have. This is a Brazilian real. It is deflating so much that in 5 years it is going to be worth less than a cent of dollars, or maybe I don't know how dollar is going to be, but it's not going to be able to buy anything in the supermarket. Let's put like that. In food, this bill right now can buy like bread and cheese. In 10 years from now, because of inflation, it might buy half a bread or nothing, or almost nothing. So this is the effect of inflation over those tokens too, okay? Not even a pack of gum. Yeah. Going fast in that direction. So before we start on Uniswap, let's see those two examples very quickly, a minute on each. MakerDAO is a protocol where you can create a stablecoin without touching fiat money. How? That's crazy. How I'm going to withdraw, deposit, and all. They create algorithm, smart contract, where market makers, they can put some collateral money, some collateral tokens, and they can withdraw a token called DAI, that is algorithmic, that is stable. Whenever it goes up, they sell for the money to go back to $1, and whenever it goes down, they buy so the money goes back to $1, either from internal factors and for external factors too. There is a market making operation there. When done correctly, like Maker, it can remain stable for years and decades. When done incorrectly, like Luna, Terra Luna, remember? It goes to zero and crashes everything. Also reflects of financials of the design of those financial services. Another example of the protocol for trading for for not trading tokens like Uniswap, for trading money preferences over assets, and it's being used for leveraging. It is a decentralized protocol like Compound, like some others that we have out there, where you can borrow money from another person by giving a collateral. And usually the collateral that you give is worth more than the money that you are taking, which a lot of people think this is worthless. I need more money. If I need to put $10 to get $5 out of it, what is the point? So it's different from the normal borrowing that you do in the street. Like, I want to buy a car, so I borrow money from the bank and repay it over time. Here, no. For you to buy a car, you need to put 2 cars as a stake. So what's the point? People use that for leverage. You know, leverage, like you can imagine, like with normal physical lever. I want to trade more than what I have. I think that this token is going to fall. For example, I think that Brazilian real is going to fall. In that example that I used a few minutes before. So I can borrow Brazilian reals like now. I can borrow those 10 Brazilian reals. I can buy some goods like bread and cheese, like the example that I used. When the token falls, I can resell those goods, and then I have like 20 Brazilian reals, 25 maybe. I repay everything that I borrowed with some interest, and I have a profit. Got the idea? If the I don't have Brazilian reals now, but I think it's going to fall. So I borrow, trade it for something else. When the token falls, I trade it back and repay everything that I borrow, right? And I take my collateral back. The problem is when the market go in the opposite direction. Then you got liquidated, you lose much more. This is something called leverage effect. There's a lot of people using these kind of decentralized platforms to leverage themselves, their position in their portfolios. This can be used as sort of insurance when you need to protect yourself from a market movement, or aggressively if you want to profit more from a small market movement, or if you're very sure that it's going that direction, you can use this kind of platform for that. So interesting designs, right? I could spend a week just going over these kind of protocols, giving insights on those different things that you can do with it. Today, I've selected one for us to study in more depth before we proceed for flash swaps and how to implement them, and how it's super cool too. That would be the integration of Uniswap itself. I guess is the other link. Yeah, V3. No, V3. Simpler. Swaps. It's different. Swaps. Wait, they changed the links, I guess. This is why I put it here, maybe. They had a place where they were explaining how to do this swap in V3. They were implementing a swap, single swap. Okay, found the link, finally. Sorry about that, took me a while. Yeah, Vladimir, okay. We're faster than me. Sorry about that. So, the idea of this protocol is that I want to exchange a token for another instantly in a single transaction. I want to exchange a token that is under my possession with a token that is under someone else's possession, right? I cannot do that instantly in one transaction, swapping 2 balances, because I cannot change the money of another person unless the person gave me approval, something like that, right? So how to include those two transactions in the same block in a way that I cannot cheat, cannot manipulate the transaction. I'm going to trade $1 million with you for euros. Okay, you're going to give me euro, let's say 500,000, something like that. I'm going to give $1 million, and then we call it quits. And then you send me the euro money, and instead of sending you the dollars, I run away with this money. And then you call the police and all. It's crazy. With Uniswap, this is impossible. I'm not going to trust a central exchange to operate that transaction for me. I don't want to trust exchanges. I'm not going to deposit my money with anyone else, but I want to operate that in a single transaction. How is that possible? I'm going to input exactly the amount that I want you to put in as an input for that transaction, and I don't know how much is going to come out of it, because the amount that is going to come out of it is determined by a factor, a product factor of two pools. Imagine two pools of water or liquid, whatever liquid would you prefer for whatever reasons. If the pools are leveled, the water, imagine like a atmospheric pressure on those pools, the water stays leveled, right? But if one pool is higher than the other, if they are connected by a pipe or something, you imagine that there is a force, a factor flowing money back for it to be leveled again, right? And if one pool has more than the other, the money would, the liquid would flow in and out until they are in equilibrium, right? For Uniswap, there are two pools of liquidity that people would deposit this money with tokens like United States dollars and euros, or Bitcoin, Rapid Bitcoin and USDC, or Rapid Ether and DAI or BAT, whatever tokens. Those pools would determine a conversion ratio, and every time that I convert from one place to the other, I change a little this balance in the pool, more or less, more or less. And the more imbalance, the bigger is going to be my conversion rate. I need to give more of this token to have that other token, or less of this token if I'm balancing back the pool. So you have those market forces pushing the price ratio back to P, this ratio. And when I do one swap, I do it instantly. If I have enough money in liquidity pool, let's say I have $10 million there in liquidity, I can trade 1 million. It's going to affect the price. It's going to slip the price between those, but I can do that instantly. And then someone can do the operation back to balance the market, okay? So when I'm implementing that, I'm going to put an exact input, and I don't know how much I'm going to get out of it. Or I can ask for an exact output, and I don't know how much I'm going to get from it as input. You cannot put both, because the conversion rate is going to be given by this product P, okay? You need to put some sort of external price control, something like that, inside your smart contract. Because if you don't, traders can front run you, can do sandwich attacks. It can do, people can do MAV, like reorganize the transactions inside a block to trade from you and all. They can do harmful things. But here we're going to do something very simple. So whenever we want to do one swap, let's say we want to do it a swap from DAI to Rapid Ethereum, or to USDC to Rapid Ethereum, back and forth, something like this. I just need to call this router, this smart contract, this routing smart contract, with the address of the token that I want as input and the address of the token that I want as output, with some parameters. And this swap router is going to direct me on the smart contract that is going to execute that swap with the liquidity pools and everything like that. Okay. So how I would do this? I can implement the address of the router as a constant inside my smart contract. We did that a few times in this bootcamp, like with Teller, Oracle, that we had an address there now. As the smart contract is going to operate those swaps, imagine the lottery smart contract. You want to accept payments in any token. You can do something like that. You implement the address of a router that's going to do those conversions for you. And whenever you do a conversion, the caller would approve those tokens to be used. And then we're going to call that method exact input or exact output by giving these parameters: the address of the token in, the address of the token out, the fee. Yes, I can pick the fee. And then people would ask, why would someone give a fee? Wouldn't it be better to be 0? Well, if I put the fee as 0, I'm not going to attract any liquidity providers, right? So you need to pick a reasonable fee, usually 0.3 or something nearby to that. So we are going to use the fee of 0.3 to attract enough liquidity providers inside that fee level. That's going to give me a good quote. So token in, token out, I can specify the fee. I can specify who is going to receive that token. I can specify a maximum time that I can wait for 1 day, 1 hour, 1 minute until that transaction would fail. The minimum amount out that I would accept, and this is that protection rate that I can use an Oracle to calculate, or I can pass it as an algorithm and all, so that I don't accept low balls. Anything up to that value is okay for me. If you go lower than that, I'm not going to accept it. It's going to revert. And there is also a slippage that I can put, like how much I can tolerate of the price slipping or changing, how much I can push the price in some direction. Otherwise, this transaction would fail. So those two parameters are more like safety mechanisms that we can implement for that swap. And this is going to be there pending until someone includes that in the blockchain and make that swap and move that money from a place in the pool to another place. We did that operation in the first lesson of this bootcamp. Remember, lesson 1, we did a swap with Uniswap. Finally, we understand what is happening here. This is the operation happening when we call Uniswap for June.com. If you want to see one example of a smart contract, I have this. Okay, if let's look at that with cursor, right? I have this in my computer. Let me just pick the correct folder here. Yesterday we were using lesson 21, right? Let me pick the folder for DeFi. Open that cursor. You can open VS Code, can open any of the previous projects and add this smart contract there. Any of the previous projects using VM, okay? Let me open my terminal in this folder. I guess I need to run npm install for this to work. I have a folder here called DeFi. Those are smart contracts for today. I'm going to do npm install. And I have put, it's a normal project like any other that you would have in this bootcamp using VM. And I have put these contracts inside contracts, and I'm going to use some scripts for today too. Okay, and for some reason I installed that using Bun. I don't recall why. And I need to check that later. But I'm going to do it npm. It's going to work exactly like that. Bun, Yarn, npm, those are just package managers. It doesn't matter if you use one or the other, they're going to do the same at the end of the day. Okay, so if I do npx compile, I should have this working. Let me see. Just small warning, whatever. Let me open this on cursor. And I'm going to show this example of the Uniswap. And this technique, this structure can be done for any token swap that you need to do in the future. Let's say you want to accept payments in any tokens from your end users in your smart contract. You can route them first to Uniswap, convert the tokens that you're using to pay for whatever token that you want. Let's say you just accept USDC or USDT, nothing else. And the user wants to pay in Rapid Bitcoin, whatever. You can just convert Rapid Bitcoin in Uniswap and have USDC out. Okay, so swap example. This is the smart contract that I have there in the README. Okay. So when you do a swap, you would put an amount. You would need to approve that amount first for swapping. And then you would swap, for example, DAI from the MSCG sender, approve that for the swap router, and then I would do this transaction. Okay. I want it to happen in the same block. I wanted to trade exactly this amount. I'm not protecting myself against sandwiches about price slippages here. This is how I would do a swap. Okay. If you recall, last Monday, no, two Mondays. When was it? Lesson 17, I guess. We were speaking about smart contract security. Remember, this is one of the things that they say. If you don't put your price swaps now, it can be front run. I want to quickly change $100 to ETH. Someone can see that the transaction there, increase the price of ETH, grab your $100, give you a small amount of ETH, and then decrease the price of ETH again and make you lose a lot of money. And there are a lot of people being sandwiched on chain right now. It's very difficult to use DEXs as a common user for big transactions and all, because this is happening in Ethereum, most of the blockchains, because that is an incentive. It costs only a few dollars to do this attack. And whenever you can profit more than a few dollars, you have an incentive to attack people. And then normal people are getting bad pulls on conversions just because this silly design. Okay. But that is also nothing that can be done out there unless you route it to some channel. But also this can be attacked. There is a lot of discussion about this. This is a swap, something that we did there in the first lesson. Okay. Question about this implementation, about the idea that is happening under the hood. Okay, browse this code is for a swap. Okay, it's Uniswap. We used that in the first lesson, remember? For Uniswap. Okay, good. Okay, and I guess you're asking about this address that we store here. So this is just the address of the swap router, like we would have the address of the Oracle that we use it in lesson 16. Yes, 16. So maybe that's your question, Browns. From that, I wanted to show something even more cool and even more dangerous on top of swaps. This is something that is possible in DeFi that is not possible in centralized finance. So DeFi is not only mirroring what you can do in traditional finance, it's going beyond. Okay. DeFi would allow you to loan money from strangers, and you don't need to put any kind of collateral. You don't need to put your reputation. You don't even need to identify yourself. You just pay a little interest, something like that. So how you usually lend money, borrow money? You have unsecured loans where you don't need to put any collateral or anything like that. You don't put your house or your car or anything, but you still can get money from banks or from other financial institutions on the condition that you would repay them. You would repay them with the principal that you took, the amount that you took, plus some interest to repay for the possible risk that you don't pay back, right? For this arrangement to be profitable. Okay. And this is banks for centuries, even millennia. A lot of people have been lending money like that with unsecured loans. There is the possibility that you don't pay, and then you would have this value called credit score to measure your ability to repay or no, or your reputation of repaying or no. The more you repay people, the more credit score you have. Okay, so they would have this risk, they would have this interest rate, and there you go. If you don't have a good score, or if you want to borrow more than your score low enough, you can do secured loans. You can put, for example, your house, your car, your stocks, whatever future revenue that you can have as collateral. So if you cannot repay the borrowed the loan that you made for any reason, they could take up your collateral and sell it for repaying the debt. They can execute it, they can liquidate you. There's two ways of doing. This is centuries old, millennia old. This is how money works. But what if you could do an unsecured loan and you don't provide any kind of collateral and you don't need to pass a credit check or anything like that? You simply ask a lender, may I borrow $15,000? And I don't present myself, I don't have any identity, I'm purely anonymous, and they say, yep, here you go, $50,000. Crazy, isn't it? What's the catch? The flash loan needs to be repaid in the same transaction that you took the money from that person. And then there is no risk. This is why this is not possible in the traditional finance. Imagine the Flash, you know, the character from the DC universe, moves super fast in the speed of light. So I take money from your hand, and then I trade it back and forth, buy this asset, sell that other asset, invest it there, reclaim that asset, trade for something else, buy iron, make a shovel, sell the shovel, and then blah, 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 and then I repay back 51,000 in a blink of an eye. This is not possible in the real world. The Flash doesn't exist. At least I've never seen him, maybe because he's too fast, maybe. But we don't have this kind of operation in the real world, right? There is no way to do a lot of transactions in a single second or millisecond with our banking system or payment system, anything like that, right? With DeFi, you can program one transaction, one big transaction, you can call that in a smart contract, where you're going to take $50,000 from a person without giving any collateral or anything like that. And then you're going to pick this $50 and you're going to do a lot of transactions. You're going to use ETH to buy DAI, and then you're going to stake DAI to mint an NFT, and then you're going to sell that NFT for another token, and then you're going to lend that token to borrow another token, and blah, 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 and eventually, boom, you have $55,000. Then you repay the borrow that you did, the loan that you did. You repay everything that you borrowed. You can repay even the fees, let's say 0.1% fees, 0.5% fees, you can repay that and still have a profit instantly. So you can right now borrow $1 billion, trade like George Soros or any big trader with a lot of money, crash markets, do whale play, whatever, instantly with a flash mint, with a flash swap or something like that, and then repay back. And in the worst case, if something happens with the loan, if you don't have the money to repay the loan, what's going to happen? The transaction will fail. Okay, I guess I have a explanation of that somewhere. This is an example of a good part. You pick 10,000 loans, you buy a token, then you sell, and then you return the loan, you keep the profit, yes. But if you don't have a profit, if you can't repay anything at the end, the transaction just fails. You don't pay anything else. Sometimes you pay the gas fees if you send that for the network. You need to profit more than what you pay for gas fees, yes, and you need to compete with a lot of users trying to do the same, yes. So it is a difficult game, but every time that you see this kind of arbitrage opportunity, you can go there and you can operate and have this kind of profit, right? And you also see this effect driving gas prices up, because every time that the gas price would fall enough to enable these kind of transactions to happen, like you pay $3 per transaction, $2 per transaction, $1.50, 10 cents, or 1 cent, then you enable a lot of transactions like this that would spark demand, would push the gas prices up. So no matter how efficient you are with your chain, what is going to determine the resting point for your gas prices is how much you have of demand for this kind of operations of swaps happening on your chain. The more liquidity you have, the more DEXs you have, the more the gas prices are going to be up, because it pays. You can do this kind of operations even if you pay $1,000 in gas. If you get 1,010, you profit $10. So it's interesting to see these kind of systems in effect in blockchains. There are a lot of attacks that happened. I have a link with that to the flash loan attacks. All of those things are very interesting for us to use as references. So flash loan attacks, they would force people into liquidation. They would force people that are solvent into being insolvent because of quick liquidations. You can manipulate the market until an asset drop below a liquidation point or something like that, force that person to liquidate, and then come back and recollect that money, and then have the profit out of it. Okay. It is something that happens like in traditional markets too. A company can force another position to liquidation now. It's considered a crime, or it can be fined in some situations, but it happens a lot in
انا بدي منك شغله
blockchain
مهمه. هاي اهم شغله
because you.
لما تكسر بالبرديش لا تعمل هيك يعني
Okay,
تكسر
open mic here. Sorry about that. It happens a lot with public pools, and not because you have the amount of value that needs to be triggered for liquidation as a public amount. It's there, everyone can see, everyone can inspect. So let's say I buy a house, I take a loan to buy a house, and someone forces me to repay that loan now. It's very difficult to sell the house at the same price that I just bought. I'm usually going to sell it below. This is because of the effect of liquidity. Being able to sell that assets for the paper face price quickly. This is very difficult. Liquidity is a problem. So you can be forced to liquidation, and then you can go bankrupt even if you were solvent a while ago. This is not like a hack, like a code exploit that someone uses a parameter that is crashing that smart contract. No, it's actually by the rules of the smart contracts are working correctly, but someone would exploit the rules of the market. Okay, and those attacks. And unfortunately, it's very difficult to find those people like Pancake Bunny attack, Alpha Homora attack, because those attacks are cheap. You can do that with like $100 of ETH gas fees. You can execute those. You don't need billions of dollars like a 51 attack or something. They are low risk, because unfortunately there is a lot of way for you to launder this money for you to get away without being caught, okay? And it's very difficult to detect those people and arrest those people. So it is a big thing how to prevent those attacks, how to protect your protocols against these kind of attacks. Okay, if you're using DeFi, smart contracts, flash swaps, and these kind of things, I would suggest you to read through this article because it has a lot of good sources. Okay, this is a big point of study for smart contract security. Okay, and for us to understand these flash swaps, flash borrows, what we can do with them, I bring you the EIP 3156. That is a proposal implementation of flash loans, flash minting, and flash borrowers. Okay, but instead of going through all of this ERC, the same way, the requirements one by one here, I'm going to suggest the implementation of OpenZeppelin that would implement the ERC EIP 3156 too would be compliant. Using flash lender or flash minter, those two would do the same, can be used interchangeably, and the flash borrower for us to get money from these kind of smart contracts. Okay, flash minter would have the ability to create tokens out of thin air for lending them. Let me find the place I was again. Increasing the zoom and scroll down. No. Flash mint. So it is an ERC 3156 extension for ERC20s that would allow flash loan giving money instantly for them to be paid in the same transaction by creating tokens out of thin air by minting them and then burning them, or the flash lender that would have the money beforehand. If I have $1 million, I can lend up to $1 million. The flash minter, no, it can mint billions of dollars and then burn them. You can also program a limit for this. And we are going to implement, this is going to be implemented in the ERC20. The token is going to be flash minter or flash lender, or a smart contract can be flash lender if it has those tokens. And the flash borrower is going to be a normal smart contract. Can be an asset manager smart contract, can be a payment system smart contract, whatever. It doesn't need to be a token. Okay, it needs to have one single call that is on flash loan that needs to implement this flash loan mechanism of giving the money back at the end of the transaction, and profiting, which is the most important part that I'm going to do, like an emulated profit for you to understand today. Okay. The ERC 3155 requires two conditions to be met when I implement this. Very simple two conditions. Let me get the place where they state those out. I'm going to find it very quickly. Yes, here. So two conditions must be included. Those two. When I'm doing this callback here on the flash lender, the person that is going to flash lender, no, flash borrower, the person that is going to borrow. The first condition is very simple. I need to return a hash of this word. Why? Just to make sure I'm using a compliant smart contract, that I'm not attaching something wrong. So the lender must verify that the borrower is going to give a callback of this hash of this word. ERC 3156 by flash borrower on flash loan. That is the first condition. Very easy to meet. Second condition, this contract borrowing that money at the end of that transaction somehow needs to give amount plus fee in those tokens for the receiver, for whomever is picking this money, needs to pay back this amount plus the fee before that transaction finishes. Otherwise, this is going to revert. Two simple conditions, okay? And I have a smart contract in that project, this Flash Minter, that is implementing this ERC20 Flash Mint extension from OpenZeppelin, okay? Which is going to have that implementation of what it is, Flash loan. It's going to be coded for us, so we don't need to code that ourselves, which is going to check those two conditions. First condition is that the return value of that function needs to be that return value, this constant here. So first condition is done for us, very easy. And the second condition is that I need to be able to burn or to collect those fees, depending if I'm configuring that Flash Mint to collect a fee or not. If I have set up a fee receiver or not. This is a configuration that I can do. Okay. So first of all, I'm checking this return value. And second, I'm checking if I can repay that transaction. This is enough for me to consider the transaction done. The person picked it and repaid in that same transaction. Look, I'm going to mint this value at line 120, and then I'm going to burn it back at line 127 or 129. That happens instantly inside the same transaction. Inside the block, there are a lot of transactions. Inside that transaction, there are going to be a lot of internal transactions where I'm suddenly rich and then I'm poor again. I have $1 million. No, I don't have it anymore. I have $1 million. I'm going to buy a Lambo. Okay, but now I need to sell that Lambo to repay. If I don't, the transaction reverts. Okay, so it's like I'm rich and poor. I'm rich and poor in the same transaction. Instantly, you see. From line 120 to line 127, for a few milliseconds, I'm super rich. But then I'm poor again, and maybe I did some profit. Okay. Ardo, you have a question there?
Yeah, is on line 125, is this the approval for burn?
Yes, I would spend the allowance and then I would burn.
Right.
And if I don't have enough allowance, transaction fails. If I don't have enough balance, transaction fails. And if the transaction fails, it's going to revert everything, including line 120. So that mint never existed. It was all a dream. This Lambo that you think that you're driving is just a dream. It is a reality inside a failed transaction. It was never included in the blockchain. It lives only on your memories. Okay.
Hi.
Yeah, Johnson.
Is there any way to find out the arbitraging through flash loan, like finding out the prices and the arbitrage with the different decks, you know?
Yeah, this is exactly what I'm going to do in this flash swap example. I have a script to call this. So whenever you are implementing this, you would send the money somewhere for it to profit, and you would collect the money from the destination.
Okay, yeah.
Demonstrating that in a lesson is tricky. This is your question, right, Jonathan? How to find this
Yeah.
situation where I can spend $10 and get 11? This is the tricky part. So what I'm going to do today for explaining this lesson, I'm going to create a fake dummy contract, magic swap faucet, where
Yeah.
I'm going to emulate some profit that's going to do trades and profit stonks, and it's going to give me some profit. But now you remember that whenever implementing this, you will need to find where it is. This is my flash swap. You will need to find somewhere in the blockchain for you to do that, and it's tricky. It's difficult.
Yeah.
Okay.
Clear. Yeah. Okay.
Usually, how people do that? You would evaluate Dune analytics. You would evaluate trading view, some charts, some places where you have this kind of data, you would track the market prices, the gas fees. You can emulate those things in hard first to see if you have a profit. If you see that you have a profit or that you can cause this profit, you send a transaction for mainnet. Okay. Imagine there are a few dozens of thousands of people trying to do that at the same time as you. So it's tricky to find a way to profit against them. But the design is like this. If you want to try this out as a final project, as something like that in your with your group, this is a great exploration. Okay. Let me run that script. I have about 4 minutes or so. I have suggested one script for us to test this. It's here in the README. The smart contract is here. The my flash swap is here. The magic swap faucet is here for us to emulate the profit. And that is an example of how you would do this trade, but then you can replace this code block by any other kind of trade that you want to do. Send that for Uniswap and then use or whatever. Try and compose some back and forths. Okay. Here I even put a to do here, to do. So this is something that you can experiment from today to tomorrow in your final project. Try and find profitable operation that you can call here for doing this profit. And then you call this one function, this dumb contract, you do this one function called flash borrow. You pass some amounts for it. You can specify these things. Okay, here I created a target trade contract and emulated profit, but those things it's up to you. In the EIP, we have some other suggestions. So in the EIP, for example, you would pass an action normal or action all these memory bytes of data that you pass is up to you. You can design your trading bot with whatever parameters you want. Okay, and depending on the parameters that you have, you can do one action or another action. This is up to you. You can create your smart contract whatever you want in that extent. Anything else of the structure you need to keep. I'm pointing that out just so that you know what you can change and what you can't. So those parameters here and this here you can change. Okay, so I have this script for testing that smart contract. I have 2 minutes for that. I'm going to do that very quickly. It is a script that is going to set up the flow. Is going to deploy the contracts. Is going to check the balances. Is going to do the swap, and then is going to check the balances again. Let me just comment this line just to explain you the setup. And then in the last minute, because I'm not going to have time actually, I'm going to do everything at once, but pay a lot of attention. npx hat run this script test.ts. It is going to check the balance that I have. Is going to call the smart contract for flash borrow. By doing that swap with that amount, you're going to see that I start with 0 of balance. Look here, I deploy those smart contracts, and my current token balance is 0. I don't have any money at all. But when I send that transaction, taking this one token of profit, I pay this in lending fees. At the starting, I had 0. At the end, I have 5 tokens. The deployer has 1 token, and the magic swap faucet lost 4 tokens in that swap. My profit was infinite % because I had nothing, and even though I could profit doing this flash swap, I created this money out of thin air, traded with it, got some profit, and then paid back my loan, paid back the fees, and had a profit at the end. Okay. And that finalizes. We don't have any time anymore. Sorry, I started the last 1 minute delayed too. But that concludes everything that I wanted to show for DeFi. There is a little bit of homework if you like this subject, if you want to explore that as your final project with your group. Prototype with this, try it out, do these scripts at home at your own pace. The snippets are there in the README. And if you have any questions, as usual, we can open your GitHub issues. You can ping me on Discord on the technical channels. We pick from there. Okay. Thank you, people. I hope you enjoyed today's lesson. Stay safe out there with your investments. See you all. Until tomorrow. Bye-bye.